In quantitative finance, mathematical models possess a significant vulnerability. Given enough historical data, a system can be curve-fit to find the exact parameters that would have generated maximum profit in the past, creating a misleading impression of predictability. Look at this highly volatile price chart. By looking backward, we can fit a smooth curve to these data points, building a model that mathematically catches every peak and trough. But watch what happens when we feed this over-optimized model new out-of-sample data. Because it was built to map the specificities of the past, it diverges from the actual price action and collapses. One rigorous approach to neutralizing this bias is a testing protocol called ex-ante cross-validation. Systematic traders execute this through a specific mechanism called a walk-forward simulation. By stepping through the 9-step walk-forward algorithm over an entire century of historical market data, we can move past curve fitting and build a durable, objective technical market indicator. To test this properly, we require a large baseline of data. We will use a century of closing prices from the Dow Jones Industrial Average, spanning from 1900 to 1998. Our test vehicle will be a systematic exponential moving average crossover strategy, evaluated on weekly closing prices. The execution rules are mechanical. The system grows long when the price crosses above the trailing moving average, and it sells to go short when the price crosses below it. The model must trade both long and short. A long-only strategy would skew the results by benefiting from the general upward drift of the 20th century stock market. We will isolate exactly one variable to optimize: N, the length of the time period used to calculate the moving average. By utilizing a simple, continuous model that is always in the market, we remove subjective interpretation and ensure the mathematical integrity of the simulation. The simulation begins by segmenting the historical data into distinct chronological blocks. This timeline represents our Dow Jones dataset, divided into one-year sequential blocks. Before testing begins, we fence off the first 16 years, 1900 to 1915, as seen or in-sample data. The remaining 83 years are locked away as unseen data. This 16-year initialization window provides enough data to capture multiple 4-year market cycles, preventing our starting point from being skewed by a single market phase. We initiate Step 5, optimization. The system runs brute force calculations exclusively on the seen data, testing the variables to find the parameter that produces the highest reward-to-risk ratio. For the 1900 to 1915 period, the calculations show that a 4-week moving average is the optimal setting. But this optimization run tells us nothing about the future. It yields a parameter that fit the past, while leaving its viability for subsequent data completely unproven. To prove the parameter, we execute Step 6, walk forward. We take our optimized 4-week setting and project it onto the immediate future. The algorithm trades the parameter across unseen data, 1916. We record trades and draw the equity line. Then Steps 7 and 8, add and repeat. The 1916 data merges back into the seen database, expanding the in-sample window to 17 years. The system immediately re-optimizes the parameter across this new 17-year dataset. It then takes the resulting optimal parameter and walks forward again, projecting the trades across the unseen data of 1917. This triggers a mechanical loop.
Optimize on the seen, project onto the unseen, record the equity, add the data back, repeat. Through every cycle, the algorithm adheres to a rule: old seen data is never deleted. By retaining the entire history, the engine accounts for the full range of volatility, ensuring parameters evolve without discarding lessons of previous market regimes. This iterative loop replicates the experience of trading a system in real time, blind to the future. For 22 consecutive simulated years, the expanding dataset confirmed that the 4-week parameter remained the optimal setting. Then, at the end of 1937, the market suffered a shock, and the strategy took an unexpected hit to its equity line. During the scheduled Step 5 optimization on the expanded 38-year dataset, the algorithm registers the drawdown. It scans the data, abandons the 4-week variable, and locks on to 17 weeks. This shift indicates the model has detected a structural change in market momentum, adapting its speed to the new environment. As the decades pass, the accumulation of seen data forces the model to adapt further. By 1992, the optimal parameter widens to 40 weeks. Crucially, the historical equity line generated in previous years is never retroactively rewritten when these parameters change. The past performance remains locked. The algorithm successfully navigated structural market shifts by reacting to the expanding in-sample data, adapting without peeking into the out-of-sample future. Step 9 brings us to the final evaluation. This matrix compares the cumulative, out-of-sample results of our adaptive strategy against a passive buy-and-hold approach. Over a span of almost a century, all exponential moving average parameters tested between 10 and 50 weeks outperformed passive holding. At its optimal 40-week setting, the dynamic strategy generated a total reinvested profit that outpaced buy and hold by more than 6 to 1. But total returns are only part of the story. To judge a system's durability, we must look at the maximum equity drawdown. During severe market crashes, buy and hold suffered an 89% wipeout. The walk-forward model cut that maximum equity drawdown by 44%. This reduction in drawdown is a key measure of a model's practical survivability. The dynamic system protects capital under duress, allowing the trader to survive to capture the subsequent upside. But look at the win rate column. This profitable model was only accurate on 39% of its trades. This is the paradox of trend-following systems. They are designed to take frequent, small losses in sideways markets, meaning they are technically wrong more often than not. The system compensates by cutting those minor losses, remaining positioned to capture asymmetric upside when a prolonged trend emerges. In this context, percentage accuracy is not the primary driver of success. While accuracy remains a factor in risk calculations, its importance is superseded by the relationship between the size of the wins and the size of the losses. System survival depends on the ratio of total net profit to the maximum equity drawdown. Ex-ante neutralize the emotional demand to be right, while eliminating the mathematical illusion of curve fitting. While the future will never perfectly mirror the past, relying on rigorous, mathematically evolving parameters provides a systematic framework for navigating market variance.